our seminar on private equity. Everyone can click the got it button that we're recording. Thank you. So today's webinar put on by Stradling, a sponsor, we're very appreciative of them, is private equity firms and their portfolio companies working with them in 2022. So we have Jason Lee and Tom Waldman, and it looks like one of you, looks like Tom, was a former ACC member when you were in-house, so thank you for that. We appreciate that. And what we're going to cover today is why PE thrived during the pandemic, some trends they're seeing in PE funds and hedge funds, PE-backed portfolio companies' approach to commercial agreements and M&A transactions, and legislative and regulatory initiatives. So we have Jason Lee, shareholder at Stradling, whose practice focuses on corporate transactions and M&A, private equity transactions, and general corporate matters. And Tom Waldman, also a shareholder with Stradling, who focuses primarily on M&A, private equity transactions, and strategic legal advice to corporate clients. So as I said, we can do the chat function if somebody has a question. If not, feel free to go ahead and unmute yourself and ask your question. With that, I will turn it over to the gentleman presenting today. Thank you.
Thanks very much, Catherine. I'm Tom Waldman. Jason is on my right in person and on my left on the screen. Yeah. We are happy to present today. The initial part of our presentation that Jason will lead is more background information on private equity, and I don't know if you could, since we have a smaller group, through the chat function or just by unmuting. If that's helpful, we can spend a little more time on that part of the presentation, or we can move further into some of the particulars of regulatory and doing business with private equity firms. So could you please let us know your thoughts on that with our smaller group here?
Yeah, welcome. And you just kind of feel free to just interrupt, and we can make it more of a dialogue than a presentation if that's what you guys want. So.
I'm not seeing any chats coming through, but since we don't really know the background of all of our participants, perhaps maybe just spending some time to just give some good background. We might have people who are really unfamiliar with it. So maybe just at least a general overview before we get started in any detail might be really helpful for the group.
Great. We'll go ahead and do that.
Yep, sounds good. Can you see the presentation now?
Yes. Yes, we can.
Okay. Right. So, here's we went over this quickly already, but the agenda for today is we'll do a quick overview of, what is private equity in an M&A transaction. What are the differences between a private equity buyer and a strategic buyer? We'll go into, the drivers of private equity activity and recent developments and trends. Why did private equity kind of thrive during COVID? We'll talk about regulatory developments affecting private equity. And then we'll get into, working with private equity-backed companies. How is that different? What are they thinking about? What do you need to be aware of when you're working with PE-backed firms? So, the first thing is, what is private equity? Well, private equity is just considered an alternative asset. So, as investors park their money, it's another place to park their money besides stocks and bonds. There are a ton of different alternative assets, private equity being one of them. There's also venture capital, hedge funds, real estate funds, and privately held REITs. The one distinguishing factor for alternative assets for private equity is that private equity, acquires and operates businesses before they exit. There are also tax benefits to general partners in private equity, but that requires a 3-year holding period. Let's do it. I can do it. Yes, no worries. So, as a target or a company, and maybe you go through the sale process, you're looking to sell your business and you get potential bids. One thing to look at is, from the potential bidders is, are you looking at a strategic buyer or are you looking at a private equity buyer? And what are the differences? So first, what's a strategic buyer? A strategic buyer is going to be, a buyer that operates in the same industry or similar industry to the target. And sometimes this could even be an existing supplier or customer looking to expand vertically. What are these buyers looking for? They're looking for kind of long-term strategic value, right? So they're looking to grow. They're looking to increase scale to improve efficiencies. Maybe they're looking to acquire talent, or kind of IP that would help their business going forward. Because of these synergies, sometimes these strategic buyers are willing to pay a higher premium, higher multiples. They can justify that because they're looking at the synergies between the two organizations, and where it justifies a higher multiple. If you're a target and you're talking to potential buyers that are strategic buyers, one thing to really think about is your confidential information and your trade secrets. As you go through the due diligence process, you'll want to be careful of what confidential information that you give to the buyer and at what point during the due diligence process you give it to them. And the reason for that is because these guys are potentially your competition. If the deal doesn't go through, they could be your potential competition, or they are your competitors already. So you don't want to give away the secret sauce. You don't want to give away confidential information unless you need to or you have to. And of course, you'll have NDAs in place, but those don't fully cover the risk if there are potential leaks. Another thing to kind of think about when you're talking to a strategic buyer is what type of strategic buyer they are. Are they an experienced strategic buyer where they do these acquisitions on a regular basis, or are they kind of new to the game, given maybe this is their first acquisition, or they just don't do it that often? And the reason you want to think about these things is because as an experienced strategic buyer, they'll have the kind of internal infrastructure, they'll have internal resources in place to kind of, have the kind of deal certainty to know that they have the resources to kind of get to the deal to completion in a timely manner. If they're new, they may not have the internal infrastructure to kind of do it in a timely manner or efficiently.
Michael had a question on how to protect trade secrets above and beyond an NDA. So I think one thing I've seen done is setting up a separate data room where it's lawyers only, or lawyers and certain third-party experts are only allowed to view trade secrets or critical confidential information. Another is
staged releases is one where that's not trade secrets, but more of your sensitive information. You'll have kind of a staged release where here's kind of your initial due diligence package, and as you get closer to a definitive agreement where you guys know there's more deal certainty, then you'll release kind of more sensitive information. And then the truly sensitive kind of trade secrets, I would say that's right. It's lawyers' eyes only. You don't share that with the buyer until the deal's closed.
So there's definitely strategies you can employ in that regard. See if there's another question here. Okay, we'll move on to the next slide and talk about PE.
So contrast that with PE buyers. So these buyers, the PE firm, how does that work? The PE firm usually has an established fund with committed capital that they are required to use for acquisitions. This capital comes from high net worth individuals and institutions, such as pension funds and endowments. And because of the way that these are structured, they usually don't have an operating arm. They're really trying to buy companies, and so they will ask the existing management to stay because they don't have those kind of resources to run the business after closing. PE firms look at it a little bit differently, whereas strategic buyers will look at the kind of the long-term value. PE firms are really focused on return on capital because that's the mandate for the fund, and so when they come in, they'll look to kind of streamline operations, kind of improve operations, reduce costs, and kind of seek new growth avenues. One thing that's kind of unique for PE buyers is there's this time horizon for their fund, right? They've agreed to return capital at a certain point in time. And so you'll see that PE firms kind of manage their acquisitions and the types of business that they buy to kind of return capital on this time horizon. And how do they exit the investment? It's through an IPO, it's through recapitalization, or the resale of the business.
Went too far, so I'll move back up. There we go.
This was the PE buyers, right? So
Okay.
Yeah.
All right.
So then a new subset of they've been around, but they've kind of gotten more popular is the independent or fundless sponsor. So this is a subset of PE firms. Here, there is no fund, there's no committed capital. Instead, these sponsors kind of use their relationships and connections with capital sources and debt sources to, approach them and raise money when they find deal opportunities. So it's done on a deal by deal basis. The main difference is, obviously there's no fund in place. And so when they see a deal that's a good opportunity, then they go try and raise the money. These tend to be smaller, but more flexible because there's no fund, there's no predetermined kind of exit date. There's no predetermined other fund criteria like a specific industry or things like that. So they tend to be more flexible. The downside, if you're a target, is that the timeline usually to get a deal closed is usually a little bit longer with a sponsorless fund because they need to go raise the capital while they're doing due diligence on the target. Another type of buyer that's similar to private equity, but a little bit different. So just wanted you to be aware of it is kind of the family office. These are typically families or individuals who have successfully sold businesses, and now they're taking part of that wealth and investing it in privately held companies to kind of diversify their family holdings. The main difference between this type of buyer and a traditional private equity buyer is they tend to have a long-term view on their investments, more so than private equity. They're, because it's their own capital, they don't have a set exit date. They also traditionally have done lower volumes of deals because of this long-term view than traditional private equity firms. So next topic that we'll go into is kind of what drives private equity activity, why has it kind of skyrocketed in the recent 2 years, and the recent developments and trends in private equity M&A. So one particular driver that for private equity is asset allocation in institutional investors. So this is basically expressed as a percentage. So institutional investors will have a mandate as to what percentage of their portfolio is in stocks, in bonds, and what percentage is in kind of alternative assets. And with the recent kind of increase in growth, strength in the market for stocks and bonds, obviously that percentage of their portfolio has increased. And to kind of stick with their mandate and stick with their asset allocation, that increases the demand to put money into alternative assets, including private equity. So now they need to commit more funds to be in line with their asset allocation percentage. They need to commit more funds to private equity, put money into these funds. And so they're building up these funds. These funds are, they've committed the capital, but the funds haven't deployed the capital yet. And so that's what we call the dry powder, which is the uninvested committed capital. So they've committed these funds to go buy a target, but the private equity hasn't found a target yet.
So the end result is that the amount of capital available to do deals increases basically in line with the stock market. And you see now larger and larger funds and more funds. The combination of the two just creates a lot of competition within the private equity industry to do deals.
Yeah, that's right. And you'll see that, and that's led to a very high volume of deals in general in the last 2 years, but particularly in private equity. Another thing that's driving the market right now is just the low interest rates. There's just more debt, more debt can be serviced on low interest rates. So there's more lending, and that leads to just more leveraged buyouts. So why has private equity kind of thrived during COVID and COVID uncertainty? One thing we've talked about is just in general the market's been thriving, and so that drives kind of committed capital. Also the lower interest rates, as we spoke about. Another thing, there's a new trend where there's a willingness for private equity to hold investments longer. So you'll see that continuation funds are becoming more popular. One thing we saw during COVID is, business owners kind of who are preferring to sell versus kind of manage through the crisis. We saw a lot of business owners kind of not wanting to deal with COVID and the uncertainty and looking to sell. So that led to, more targets being available. And so just more, I would say, increasing the volume because the supply was increased. Another thing that kind of helped PE was sectors that were traditionally popular with PE kind of thrived in the pandemic. And these sectors include, obviously the tech was booming, healthcare, and also logistics, which PE has traditionally invested heavily.
So I'll take over here to talk a little bit about some trends we're seeing that are affecting private equity funds. The main one is the increased regulatory scrutiny. Follows from the change in administration primarily. There's an interest in both learning more about the private markets, increasing the level of disclosure, and there's interest in regulating the activity as well. We'll talk a little bit more about that in a minute. Second thing we're seeing is really a blurring of strategies. So we describe private equity as, buying control of companies and holding them for a period of time and then selling them. And that's still the main strategy for private equity firms, but many of them, because it's so competitive and so much capital there is to deploy, are seeking new ways of putting that money to work. So we've seen private equity funds with growth capital strategies. So they're investing in late rounds of emerging companies on a path to an IPO or a sale. We've seen hedge funds become VC investors. So instead of buying and hedging public securities, they're investing in private companies, sometimes very early stage, and often much larger amounts than traditional VCs are willing to do, which has shaken up the market quite a bit. And the unicorn phenomenon has a bit to do with those hedge funds changing strategies and looking for investments where they can put a lot of money to work at once. There's increasingly non-traditional lenders in the market, where we talk about non-bank lenders who are funds essentially using insurance fund and insurance company and pension money to make loans, competing with banks, but then also trying to make equity investments at times in order to improve their returns. And again, it's a competitive market, even on the lending environment. So these funds are trying to put money to work. As the market accelerates and sellers do better, family offices are proliferating. So families sell their businesses, they have capital to invest. They will either invest in funds or will go ahead and start acquiring companies that are adjacent to or even completely different from the company that was originally founded by the family, but try and bring the management expertise they had that made them successful in the first go around to a new investment in a private company. And then sort of the last recent development is very long-term holdings are now being accepted as an institutional investment. So whereas before the turnover of capital was important to institutional investors, increasingly they're willing to do these continuation funds where there is no definite time frame to realize the entire investment. There may be distributions along the way that provide some cash flow, but generally the view is it's as long as the company is profitable and competitive, the private equity fund and the institutional investors behind it will hold indefinitely. Then another factor that we're also seeing is ESG becoming increasingly important to private equity investors. Our view at Stradling is that's really being driven by the institutional investors. So your pension funds, for example, large corporate pension funds, state pension funds are interested in seeing particularly environmental and diversity, equity, and inclusion issues brought to the forefront by individuals and firms handling their money. So that's an important factor now that private equity looks at in evaluating transactions and also in working with their portfolio companies to strengthen their systems and compliance around ESG. So I think that will be increasingly important going forward. Let me quickly check the chat since looks like we had a question. are we seeing an effect yet from rising interest rates was a question from Catherine. A little bit. I think there was sort of a bit of a pause in the market, in part because the public equity markets are feeling the effects of that change. But in some ways, there's also a rush to use the money before it gets too expensive. So it seems like the overall deal pace will stay strong, at least through the rest of this year, until the Fed has really moved interest rates up substantially. But it does feel to some extent like the uncertainty around inflation, interest rates, and the like will have an effect. Just people haven't necessarily been able yet to process what those effects will be, or whether they'll really affect the economy overall and appetite for consumer goods and B2B purchases and things like that. So we'll see an effect when operating businesses start to cut back on expenses to meet debt obligations. But I think until then, there's not going to be a change in deal activity, in my view.
No, I think that's right. I mean, I've heard chatter about, people thinking about these different factors, but it hasn't really affected kind of the deal volume yet. But I know it's on people's minds. I think as we get into more uncertainty, I think it will affect the deal flow. But for now, I think it's still kind of steady, at least the private M&A flow.
Yeah, and we're coming off obviously of historical lows, and I'm sure private equity firms at least anticipated that those wouldn't last forever when they budgeted their investments to some extent. But in general, obviously the higher debt service costs is going to affect the economy overall, and that will certainly affect the level of activity in the market.
I think you'll see maybe a switch in kind of how the deals are structured, but there's still a lot of uncommitted capital that's out there. The funds they've raised a bunch of funds that need to deploy the capital. So I think that the deal flow will continue to be strong, although maybe structured a little bit differently with debt.
So we'll jump now to my computer will comply. There we go. We're jumping to regulatory developments in private markets. So as mentioned a little earlier, the SEC has begun to use its authority to regulate private markets, really in a way that we haven't seen before. And the private equity industry relies on, essentially the exemptions under the Investment Company Act for qualified institutional buyers, Reg D, to bring in up to 99 other partners who are not necessarily QIBs. And the result has been, the industry is completely opaque to the public at large. And the SEC is now trying to get underneath that to a degree that's new. So they've already adopted what's called Form PF to try and get an understanding of where investment dollars are going in the private markets. And then there are new proposed rules that combine enhanced disclosure to investors. So all of a sudden the requirements on what used to be a private company start to look a lot more like what public companies need to do in terms of reporting, even including an MD&A, and starting to bring through regulation the indemnification of general partners and imposition of what they hope will be state fiduciary duties, more in line with what public companies have to do, with the view that protects the interests of investors. There's increasingly ways for individual investors to find their ways into private equity. several publicly traded stocks and private equity firms. There are, different types of vehicles that will pool, still relatively wealthy individuals, but not necessarily institutional investors into a group to make private equity investments. And there's, increasing movement to allow private money to go in 401ks to go into private investments. So all of that, I think, is driving the SEC's views that the industry needs more regulation, and that its size and its rapid growth over the last few years due to asset allocation is potentially a systemic risk. So it, obviously leaves to be seen how far those changes will go, and whether the SEC pares some of that back before final rules are adopted. But clearly the trend is to bring the private markets more in line with the disclosure obligations of the public markets, and to give the public a better view of where pension and other money is going. The other sort of consistent battle between private equity and Congress is taxation on private equity investments. General partners generally will invest, say 1% of the funds in any transaction if it's successful, sometimes above a hurdle rate, sometimes not. They'll receive 20% of the gain. That's always been structured through the 30 or 40 years that these private funds have been around as a capital gain return. A few years ago, the 2017 Jobs Act made the requirement to hold those investments for 3 years. They're in the Build Back Better plan that was rejected by Congress. The holding period was going to change to 5 years. And there's certainly members of Congress who talk about eliminating capital gain treatment for private equity general partners altogether. So that will be an ongoing story. Whether it really changes the way people think about the benefits of investing that way, it probably goes into a soup with the SEC's rulemaking and general competitiveness of the market. But in the short term, I don't see any real effects. Another place where rules are potentially changing is at the FTC. There's a proposed rule that will close a loophole that private equity funds have taken advantage of, being structured as partnerships, sometimes multiple partnerships investing in the same transaction. I don't want to use the word evade, but I can't think of a better one. Private equity funds don't meet the size of the person test, strictly construing the rules in a lot of cases, thus avoiding the need to make HSR filings, which, certainly in the view of the FTC has unbalanced their ability to monitor what's going on in the market from an antitrust perspective. But the rule has been pending for a while. It was proposed in fall of 2020. It hasn't gone final yet, but it would treat sort of any associated group of funds under the same management as a single person for purposes of testing size of the person under HSR. And that would be a change that would bring private equity buyers more in line with what strategic buyers need to comply with. The other change that has been in effect for 3 or 4 years now, but certainly different from the way private equity funds operated historically, is CFIUS now requires the fund to look through to its investors to understand who resides outside the United States, and then submit a CFIUS filing if in fact they meet the criteria as a foreign person, which is 20% generally of the capital being invested in a transaction. So that's another regulatory change that affects how deals are done and how funds are raised, and will continue to the extent that the international dynamics, increased enforcement by the State Department will definitely change how deals are done or who's able to do deals, depending on their sources of capital. So how does this affect corporate counsel, this fine group? The general trend will be to level the playing field for public companies and what have been sort of freewheeling independent private companies, small businesses, effectively managing capital and able to do deals without the same level of regulatory oversight as their public peers. At the portfolio company level, so private equity owned firms, as these reporting obligations come into force under the new proposed SEC rules, we'll start to have many of the same burdens that public companies have as far as quarterly and annual reporting. So whereas before there's often an argument that a take private, particularly of a smaller public company, involves significant cost savings because of lifting that quarterly and annual compliance burden and the like, that, quote unquote advantage that private equity has as far as gobbling up small public companies will, in a sense, kind of go away, right? Because the reporting costs will be in line whether you're owned by an institutional investor through a private equity fund or through the stock market. The other change then will come in how the private equity firms approach transactions. If those reporting requirements are in place, they'll need to do the same analysis a public company has to do when it goes to buy an asset. Does the target have the right reporting infrastructure from a systems perspective, a personnel perspective, its ESG policies? All of those will be more important. I know the vast majority of San Diego ACC members work for public or large private companies. Those are always important to you in executing transactions, and they'll become increasingly important to PE firms that are competing for the same transactions. Again, the general trend to level the playing field, bring private equity transactions more in line with what public companies need to do. Happy to take any questions before we jump into the next topic, if anybody wants to interrupt now. I'm just going to share a little bit of my own experiences in-house of private equity in terms of how we tended to work with peer companies that weren't necessarily owned by private equity. I guess there are none, so we'll just we'll keep going, but please interrupt or save questions to the end, one or the other. So some of the things I experienced when I was in-house, I've been back in private practice for almost 4 years, but these are sort of come from my war stories of having to act essentially as outside general counsel to PE-backed companies during my time in-house. So private equity companies typically will operate independent of their ownership. They're really reporting to a board of directors that is made up of personnel from the PE firm and outside experts who are brought in to sit on the board. But the day-to-day operations are generally independent. There's not a management structure that sits at the private equity fund level. But there is a lot more sort of routine interaction between the board and management than there would be, say, with a public company board, because that private equity firm is supposed to be there to provide business advice and strategy, and sometimes that will flow through to, transactions of a certain size need approval by someone within the private equity firm, or other ways that sort of increase the level of interaction from what you'd normally see. But still, ultimately, the private equity backed company is independent. It's setting its own strategy, deciding who to contract with and where its business needs to go. There are some exceptions, but typically a private equity firm is really providing advice and recommendations. You're not going to be told, if you're in a private equity backed company, that you need to work with a certain vendor or adopt a certain IT system or things of that nature. Again, that goes to the independence of the management team, not necessarily being part of an integrated whole. It's not same situation as a public company where, ultimately an acquired business needs to integrate completely, both from a management perspective and a systems perspective, so that reporting functions and the like will all work seamlessly. Private equity funds treat each portfolio company as an independent business, and so different in that way. The other thing to think about up front, if you're opposite a private equity backed company, is, what is the creditworthiness analysis? It's probably not as much the case currently, but certainly has been in the past, that private equity firms are over leveraged, right? The amount of debt that they carry tends to be more than traditional operating businesses or public companies. The risks, for example, of a sudden upward movement in interest rates or loss by that private equity company of a significant customer is much more significant than it would necessarily be for a public company. And while it hasn't been the case in the last few years, there have been many spectacular bankruptcies of private equity backed firms over time. And generally, a financial team for any one of you will do a credit analysis and look at a balance sheet, but there's sort of a subjective analysis that has to be done as well. There's not necessarily a focus on ratios, but also understanding the commitment of the financial sponsor, the private equity firm, to growth, to supporting the business, and things of that analysis, things of that nature, I should say, and then combine that with the objective analysis that your credit scoring would normally do, as far as how to rate the company in terms of its creditworthiness, ability to pay its bills, the amount of time you'll afford them to pay, and the like. So that's an important thing to do up front, and a little bit tricky, because these companies are often acquisitive, right? The private equity firm will buy one as what they call a platform, and then look to do add-on acquisitions. Those acquisitions generally mean more debt and more risk. So even in an initial evaluation, everything may look good, but sort of you got to remember to update that over time, and make sure that your company's financial goals are going to be met in case of a sudden change in the markets, interest rates, whatever it may be. When you're doing business with a private equity firm, understanding their financial goals is important. It's often the case, though not always, that profitability is going to be more important than revenue to your counterparty in a transaction. So, the way price and terms are negotiated, if you understand that and have a view and can sort of tease that out in a negotiation, you may have a better understanding of where there could be movement in your favor. the second thing to understand is often for a private equity firm, the long-term relationship is extremely valuable because they do generally want to, absent a continuation fund structure, they're generally looking to sell the business. They'll want to show, if they're working with a vendor, that they have consistent and set price sources of supply. They're working with a customer. They'll want to convince the buyer that it's a long-term customer, and there'll be a contract around when the new buyer steps in, whether that's a strategic buying from a private equity fund or another private equity fund that's buying them out. So again, that's sort of a point of emphasis for a counterparty, that if you can understand what their goals are, hopefully that works to your advantage in negotiation. And so here are my views on sort of what contractual terms are important to PE-backed companies. Top of the list is limited non-assignment clauses, change of control termination rights, things of that nature. Those may or may not be important to a business that's on the other side of a transaction. To a private equity fund, they should be critical because they need to sell the business. So they'll push hard for exceptions to assignment clauses for sale of the entire business, to not have any change of control restrictions. In sort of the same vein, parent guarantees are a real hot button for private equity firms because they're generally written to survive a change of control transaction. And if you're supposed to be returning capital to your investors and be done with an investment, it's not a good situation to have a guarantee in place that now benefits the new owner. And it's so important to them that if they're working on a commercial contract and the other side is pushing for some kind of parent guarantee, they'll start looking for other commercial partners. It's so understanding that, even though it may be part of the formula that makes your business successful, when you're working with a private equity firm and getting that contract done is important. You recognize that that's a hot button, and try and maneuver around and not lose the relationship necessarily over that. There's another way of getting comfortable in the creditworthiness of the other company that's owned by PE. In a similar vein, limits on liability are going to be very important to a private equity firm because they're often, or almost always, using debt to understand the downside of a potential commercial relationship is really important, and not putting them in a situation where some catastrophic error, whether or not covered by insurance, inhibits cash flow. So you'll see a lot of negotiation around those terms from private equity backed companies. And although long-term contracts are often important to private equity backed companies, they'll often look for a way to get out of those long-term commitments because they seek the flexibility to sell to someone who may be your competitor if you're sitting across the table from a private equity backed firm. So that has a tendency to look like a very one-sided request. May not get there if you're representing the private equity firm, but it does come up and is often important to the folks behind the scenes who are sitting where I did in a private equity firm. And that brings us to the end of our presentation. So we've left 10 minutes or so for questions, and would love to have people unmute and jump in and open up the discussion.
Well, I'll ask the first question. Thank you, gentlemen. That was excellent. if someone's looking to look for, either work with a strategic buyer or, or PE buyer, you said there were different timeframes, maybe with an independent or a fundless sponsor. What would a company expect? Are we talking 6 months, 9 months, 1 year? Like, how long does this process realistically take? And I know there's a lot of caveats in there, but what is a realistic timeframe?
Well, a traditional private equity firm, because they bring to the table, expertise in doing multiple transactions, will often, at least initially, promise to be done in 60, 90, 120 days, completing all their due diligence and negotiations. An independent sponsor will probably land in more of that 6 to 9 months type of time frame, because after they finish due diligence, they have to raise capital based on their findings. So instead of things running in sequence, they're essentially running in sequence rather than in parallel. And that's probably similar to what I see strategic buyers take, because their processes tend to be more attenuated just because of the number of people, divisions, interests within a larger company that need to be satisfied to make a transaction happen. So to me, a strategic transaction will often take closer to the 6 months than the 90 days to get done.
Yeah, I think that's right. Especially with the strategic buyer, there's integration issues that come up that they will be hyper focused on, that usually takes longer to diligence out. There'll be a lot more stakeholders in terms of different departments wanting to kind of review, important factors that are, department specific for integration. So the diligence is usually longer. And again, it depends on, what type of strategic buyer it is, because if it's a strategic buyer that's kind of done this, it has been doing this for a while, they generally have a playbook, in place, they have the internal resources to do it. So you'll find that they have a more truncated process versus if you're talking about a kind of a new strategic buyer who hasn't done it that often, those tend to be longer into the 6 to 9 month, category.
Well,
Other thoughts, questions?
I'll keep asking just to see if we can generate some
Please.
conversation, but that's okay. If anybody else wants to override me. If the transaction doesn't go well, what's generally the cause? So, you go to partner with someone or someone invests in your organization. What's kind of a big red flag where you can almost look at it and say, this is probably not going to get to fruition?
On the transaction side, or before an acquisition takes place?
Oh, maybe just a red flag on both. Yeah.
Yeah, I would say before a transaction takes place, generally it's going to be either external changes in the market that will have the private equity fund rethinking what the value they proposed is, or sort of peeling the onion in a sense of doing due diligence and finding things within the company that weren't, in the private equity firm's mind, readily apparent when they first sat down and negotiated a letter of intent. Those are probably the main things. I think the other factor that could happen behind the scenes is if they're hoping to bring certain new participants in management into the company, and those negotiations fall through, then lots of excuses will be made, but it won't make sense for the private equity firm to invest anymore. And that's not going to be apparent to the counterparty on the other side, but it's something that can happen because the investment thesis is around a particular manager's experience or contacts in the industry or whatever it may be, and all of a sudden those aren't available to realize the value that they thought they would get on the deal.
Yeah, I agree. A lot of it is diligence. When they get in there and they start looking at things, it's just what they had expected they don't find, and that's kind of the that's the red flag for them. So,
After a transaction's done, not working out, I'm probably too much debt is more important than anything else, right? If the company doesn't grow in the way that's anticipated in its financial plan and can't service, what tended to be increasing amortization over time, that'll drive the equity portion of the deal down to zero. And competition as well, right? You go in with a certain view of having a place in the market, and just things change, new competitors, new products from competitors, whatever it may be, and all of a sudden the sales aren't there.
What type of exit options are available? Kind of that post-transaction buyer's remorse kind of position. I mean, obviously you're probably not going to IPO it at that point, but is it really just kind of split and sell, or just recoup anything, or what do you kind of see usually happens at that point?
Well, there are a couple of different options. We've seen a private equity firm try and break up the company and find a valuable piece that's of interest to a particular buyer and try and delever that way, and then hope the rest of it can sort of muddle through. Similar to strategics or public companies needing to sell off an asset to service debt. That happens in all markets. But private equity firms can hold, right? They can say, we're looking at a couple of tough years and we'll work with our lenders and try and extend terms. And when things improve, the business will improve and we'll be able to make our money then. So they're sort of, aggregate return or IRR, because that's measured against time, may not be spectacular, but that's often what you see. It's just, let's try and cut costs, batten down the hatches, and wait out the tough times. Change management, whatever it might be, to see if luck improves. And I think that's probably even more common than either selling quickly or trying to break up the company and find some value in one individual asset.
That's helpful. Thank you.
Any other
Catherine,
questions?
There are none.
Well, thank you both. I'm very appreciative of the webinar today. Very informative. Audrey, I believe we email out a copy of the slides. Is that correct?
I'll post it on the website.
Okay, so slides will be posted on the
Great.
website. Great.
I'll send that over to you, Audrey, and appreciate everybody listening in, and we'll see you all at the next ACC event.
Exactly. Thank you both, gentlemen. Appreciate it.
Thank
Have a great
you.
day. Take care.
thanks,
Thanks,
everyone.